The Fed has gone from this to this. Interest rates are rising aggressively, and the impact to the housing market and the stock market could be massive. I'm Biko Konstantinos, and that's what we're going to talk about today. If you like birds, why don't you give this video a like? And if you want to join me to keep on top of a broad range of finance topics, please consider subscribing to my channel. I'd love to have you on board. Now let's see what that pesky Fed's been up to and what it could mean for the markets. Back in 2021, the Fed was extremely dovish, and by that we mean they were happy to keep interest rates extremely low, and on several occasions they stated their belief that high inflation was only transitory and it would drop back down quite quickly. Now, by late 2021, it was clear that inflation was not transitory and these high levels were going to stick around. The Allianz chief economic advisor even labeled the transitory call as the worst call in the history of the Fed. As you can see from this chart, the CPI headline inflation in the US has been surging and has now hit 7.9 for the 12 months up to February 22. So from October, November, I think the Fed knew that inflation was becoming a real problem, and the further rises after that have seen them completely change and pivot from their dovish stance to now a much more aggressive, hawkish stance. Now, when we say hawkish, it refers to a much more aggressive policy on raising interest rates to curb inflation. Now, the Fed is currently in a major predicament. It didn't take any action for a long time on interest rates, and now inflation is so high, it could now be very difficult to try and rein that in. However, prices are rising very quickly, and it's having a major impact on everyone. Add to this the Russian invasion of Ukraine, which has resulted in some very big sanctions against Russia, but also counter sanctions and potentially a very large disruption in the oil, gas, and wheat, amongst other commodities that gets exported from Russia and Ukraine. So the very difficult inflation position that the Fed had has now gotten much, much worse. So what's the Fed doing now? Well, this month, March 2022, it's risen interest rates for the first time since 2018. Now, rates were risen by 25 basis points, and the Fed predicted another 6 this year in 2022. However, comments by Fed Chairman Jerome Powell have even become more hawkish. Powell has said that inflation is much too high and the Fed will take necessary steps to address. Many commentators now believe that the Fed will raise interest rates by 50 basis points, potentially in May or June 2022. So there's been a massive change, and it looks like the rate of interest rate rises is going to be much, much faster than we originally thought back in 2021. One of the big issues that I see is that investors just aren't used to interest rate rises. For many years now, interest rates have been on a downwards trajectory, and most of us have forgotten what it's like to be in an environment where interest rates are actually going up. The real worry is for people who have gotten massive mortgages to buy a home, expecting that interest rates would stay very low for a long time to give them a chance to pay some off the loan. However, that hasn't eventuated, and if they haven't fixed the loan for a long period, there could be some major trouble ahead, with repayments going to increase exponentially as the interest rates rise. Mortgage rates in the US are going up even faster than interest rates. The average 30-year fixed rate mortgage is now above 4% for the first time since 2019. And at the start of 2022, it was around 3.2%. So we've already seen a rise of nearly 1% on fixed rate mortgages in the US. Now, this inflation dilemma isn't just affecting the US, it's practically affecting every country in the world. The Eurozone is being impacted greatly because they're more affected by the Russian invasion of Ukraine due to their imports of oil and gas and wheat, etc. So the majority of countries around the world are starting to raise interest rates. And because we're starting from such a low level, the impacts are going to be more profound. For example, if someone has a variable mortgage rate of 2%, interest rates only have to rise 2% for their repayments to approximately double. And we can guarantee that doubling repayments would have a massive effect on budgets and could send some people into a financial crisis. So what does all this mean for the housing market? Well, personally, I think that the biggest contributor to the crazy house price rises we've seen has been the ultra low interest rates. It's allowed people to be able to borrow so much more that they can offer more on houses, and it's allowed people to be able to get larger mortgages because they're able to service them due to the very low rates. So if the majority of the housing boom was caused by ultra low rates, raising those interest rates will have a very large effect in my opinion. It all depends on how fast they're risen and how high interest rates actually end up. The current prediction of the Fed of 6 more interest rate rises this year will most likely have a negative effect on house prices in the US. However, these things usually take some time to come through, so we might see a bit of an easing off before some declines in house prices potentially. I personally would expect a similar scenario playing out over the house prices in many other countries. When interest rates rise, the banks will not allow people to borrow as much, so they may not be able to offer the prices that the sellers are asking for, and this could then lead to prices dropping. The real risk will be if inflation stays extremely high and interest rates need to keep going up higher and higher. If this causes mortgage rates to rise to say 7 or 8%, then we might see a crash in the housing market because many people will struggle to make their repayments at those levels of rates. However, that would be a worst case scenario and definitely something the Fed is trying to avoid by getting aggressive now. So what do you think? Do you think the Fed is going to be able to curb inflation so they don't have to raise interest rates too high? Or do you think they've left it too late and high inflation is now entrenched for a long period? And what's your thoughts on house prices now we're in an environment of interest rate rises? I'd love to hear your thoughts in the comments below. I don't think anyone knows what's going to happen for sure because we've seen so much volatility across housing in the past 24 months that nothing's really out of the question. We could see further rises or we could even see a crash. That's how difficult it is to predict. Hey, thanks so much for watching this video. Why don't you subscribe? I'm Biko Konstantinos and I'll catch you in my next video.